Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in. And if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi, everyone, and welcome to episode 43 of the Capital Mind podcast. It turns out SEBI doesn't want your next fund manager to be an algorithm. There was a consultation paper last week where SEBI has thoughts and perspectives on algo trading and uses of APIs. And they put this out there, and it seems everyone's in a bit of a tizzy. So we wanted to bring in Deepak to talk about this. Deepak, what's this regulation for? What's the intent? What has it said?
Hi, Shrey. I think, there's been so many Twitter spaces and, a bunch of videos and talks about this. But it's interesting to note why SEBI wanted to introduce this in the first place. There's a bunch of interesting things that have happened. First, this is not actually to ban algo trading per se. I think it's a regulation that affects something called an API trading. A lot of brokers, roughly 44 to 45 of them, have now announced that you can trade using an API, an electronic interface. So the idea being that if I told you to trade, you would go open a screen, you would press F1 or F2 whenever you had to buy or sell something, click the quantities and the amounts and click enter, and that would generate a trade that would be sent to the exchange. Now, what the new parlance of, whatever it is, whether it is trading or anything else, people use technology using something called APIs, programmable interfaces or programming interfaces. APIs are basically saying, listen, instead of you punching something on a screen, why don't you send a structured thing that says quantity 10, something 5, price 50 rupees, type limit order. If you send me this entire thing as a string and over the network, I will automatically place the order about whatever you said. So you don't have to open a screen or something like that. So therefore, I could send it by typing it in, or I could write a program that sends it automatically to the exchange that says, well, you can, why don't you do this? Of course, you need a little bit of bunch of things behind it. You say you have to be able to use an API. I don't want unauthorized people to use it. So you have to have an account with us. You have to you maybe have to pay. In certain brokers ask you to pay in order to use the API in the first place. The last bit could be that you need to authenticate every day. So I can't just say, oh, I'll give you my username and password and you can trade it anytime. Now, this APIs are largely intended for people's own use. So I could program my own account. And why would this be useful? For instance, I want to buy a stock if it hits 800 rupees. Now, the exchange rules say that you cannot say buy a stock at 800 rupees because every day you have to place a new order. They flush out all the orders. So I have to go in the morning and manually place an order every day. Instead, I'll write a program that does that. Now, many brokers offer this as a good till traded kind of an offering. Now, the issue with this is, of course, it solves one use case, but I might want to do multiple different sets of use cases. I have a bunch of stocks, and whenever they fall 10%, I want an automatic sell order because I don't want to lose more than 10%. And I can have an API that tracks the stocks that I use and automatically send a 10% lower sell order, a stop loss order, if you may, every day. To be able to do this, I can use APIs, and brokers, like I said, 44, 40 or 40 plus of them provide APIs now. The issue that SEBI has started to come across is that there are now third-party platforms that offer the use of APIs through algorithms. That they say that you just have to connect your account with any of these brokers with us. That means give us your API keys and so on. We will automatically trade on your account, and look, our algorithm generates so much profit. This is where SEBI comes from. Is the intent now to say that anybody can get lured by this third-party algorithm, if you may, in quotes, and therefore get gypped because that algorithm doesn't perform as it's supposed to do, or that this person who's giving you this algorithm actually has malintentions. So the first intention is to protect that end user, to say that if they're buying something that presents a certain return profile or risk profile, and maybe even charges a fee that is 30% of this thing. And I know Vashisht he has strong views about that as well. But that part of the intent is clear, that you can't just go around and say, I'll give you this many returns, I'm an algorithm, and now target anyone with an account value of even 100 rupees to be able to share their balance. So the intent is to protect them. The second part of the intent is also, and they have said this, that there are regulations that govern algorithms. Those algorithms need to get approved by a stock exchange. Those algorithms also need to go through a vetting process and be handled by the broker. The broker needs to introduce them to the exchange and take care. You get an algo ID and all that. Why aren't these APIs also under a similar level of control? How can third-party platform run this without having similar levels of control? Because they could potentially form a threat to the exchange. So there is a problem in that algorithms can form, APIs can be misused if I collect a bunch of people's API IDs to be able to send a lot of orders to the exchange that can manipulate the price of a security at one level. And second, cause a damage on the exchange itself. For instance, if I send too many orders at the same time, won't it result in the exchange having to deal with, it's like websites getting down because of denial of service orders. You could have an exchange go down because of too many orders coming in from an API. That's a fear. I'm not saying that we can handle all of this, but this is the intent of the regulation. They've said, listen, all APIs are algos, therefore they should be treated like algos. They should be registered with the exchange, which is a complicated process. It should run only at the broker to avoid us trying to figure out who all are using these APIs, put the load on the broker itself. It should, there is a nature of it, and they haven't specified what. That is also of the form of advisory. Because technically, if you give me your API access, I can call it an API, but technically I could trade on your account automatically without your approval, specific approval, anything that I wanted from using your account balances. Therefore, technically I'm advising you or managing your money. So what regulation then governs you? Is a question that they haven't answered in this consultation paper, but they have kind of brought it out and said, hey, well, there's a problem here. So the consultation paper, while it's early, currently goes the other end and says all APIs are bad.
And it places the onus of regulation on the brokers themselves, saying, look, these third-party people, they can't come and offer APIs directly as a marketplace. So brokers, if you want, you go find some third-party people and build a relationship, bring their algo, get it approved from the exchange, and then you can offer it to the customers. But the algo then runs on your systems, not on the client's end.
So Vashish, you had two observations when you saw this. The first was you felt that APIs in this, they're almost like becoming proxy fund managers in a case, or money managers, if that's the right
if
way.
I have access to 10,000 API keys and their secrets, which means I have access to 10,000 accounts across several brokers, how am I different from a fund manager? In effect.
And your second one was the way they've done the regulation as well seems to be removing personal choice, where now if they actually go ahead with this, they'll allow perhaps a broker to empanel someone and put the algorithm. But you, say, are a tech-savvy person, you're not allowed to do this on your own machine, right?
Correct. You're not allowed to, because one of the provisions says that the algo needs to be running on the broker's infrastructure. But the problem is, all the new age platforms, they're all web-based. They all in any way work on APIs. So if I'm logged into Zerodha and I open my browser, save the cookies, and then run another server on my computer, which calls the same APIs at the front-end application, the client-side application is calling anyway, the same set of cookies, I can use those APIs regardless, whether Zerodha ever offered me a API as a service, paid service or not. It was always available. Now it's web-based. Earlier, people used to hook into the Nest platforms and automate trading with other software like AmiBroker and so on. So now it's even easier on a web-based platform. So I don't know how you can block this from a very determined tech-savvy person.
Fair enough. So, I mean, Deepak, you've pointed out correctly that there is, I mean, if I may say, an investor protection angle here. I mean, and also sort of what's the right regulation? You're trying to help people out and prevent bad actors. But how does SEBI do this without killing, as you just pointed out, killing the entire API industry? I mean, how do you, find that balance?
Yeah, I think here is where it's important to understand that we need APIs in the sense that, of course, like Vashish said, there is no difference between a broker's own application using it and you're using it as a third party. Now, they've given you an official API key to do it, so they know that you're the one who's doing it outside of. So, for instance, I could just look at the traffic between Kite and the Zerodha servers and replicate it using a code that I have written because it's not complicated. People have done this earlier also. When there was no algo of any sort, there was a application called Nest, which required some screen keys to be entered. So if I create F1 and I typed a quantity and a price and a symbol name on a particular set of cells in a screen, that would automatically become a buy. So I could write an external program, and I will not name who, but I know people who have written programs which would send the F1 key, highlight the particular cells, send. So if you just send, for instance, F1 symbol name, 2 tabs, quantity, another tab, something, it would automatically generate the buy without a human needing to enter anything, except to Nest. It was a human being that actually typed it. It was just typed very fast.
Like a macro. It's like an Excel macro.
Exactly, Excel macro. So you're actually replaying what somebody would have done, but you're doing it through a program. Why is that any different from an algo trading program accessing an API? So the
same thing is being done with in the browsers with a Puppeteer or a Selenium, where you can simulate users' actions.
Correct.
Which is what a lot of people do because, like you said, the APIs, for example, Zerodha's, the access tokens, they expire every day at 6 a.m. So how do you then generate the next one for the next day? You have to manually log in. Or you can, set up a browser automation which goes and logs in automatically and gets the token.
Yeah, so the interesting thing about doing this API layer protection is you're protecting in a very superficial way. Somebody who's really keen to get in, and there are lots of people keen to get in, you're actually, by saying all APIs are algos and you need an MBA and to be able to write an algo, which is very possible that a regulation comes along that direction. What therefore is you can't stop APIs. It's not useful to stop an API. So what we should do, according to me, is address the intent, not the. So the end action seems to be like I'm using a sledgehammer to kill a mosquito. You may actually kill the mosquito, very good, but you've killed a lot more than the mosquito itself. But also, it isn't desirable to use sledgehammers in any case. Sometimes mosquitoes are not going to harm you, and sometimes mosquitoes are. So the question is, what do you do for mosquitoes? I have a personal enmity against, so I will not have any problem in anybody not eliminating them completely. However, coming to the solution here, our problem is, for instance, the intent was to protect the small person. And what are you protecting against? You're protecting against somebody giving them bad algos, which goes and completely dumps their account to zero. Now, people are capable of understanding when their account can go to zero, but they don't understand how an algorithm can do it automatically. We don't want this to be automatic. So my suggestion is that for everyone, an algorithm that generates a trade should pop up a approve or don't approve kind of a screen on your computer or your mobile device before that trade is accepted. This is similar to UPI. If somebody requests an UPI from you, you will have to say, yes, I accept, and enter a PIN. Only then does it go through. So you could have a similar regulation that happens that says, well, this guy is requesting that a trade be done in your account. Do you approve? Yes. Of course, this will hurt a lot of people who want instant execution.
Or fully automated strategies.
But let's come to that in a different way. This will solve about 50 or 60% problems that the SEBI is having, in the sense, if a person even gives away his API key, for every trade they're getting an approve or disapprove. If they click approve, only then is it going through. So effectively, what the other person is giving you is only advice. Your execution is yours. You could have said no. And this you could have said no is very powerful, because now you cannot deny that you pressed yes or no. And you can't tell SEBI that I gave someone access and then he sent me a trade. I actually clicked yes, but now he has fooled me. But it's a little more difficult to make that argument versus giving a password and username at one time and then not realizing that this person is traded in your account. The second part of this argument is, well, no, but we do want to automate our strategies, and we do. So my point is, like the way you have with fund managers, there's a 50 lakh rupee limit for PMS customers or a 1 crore limit with AIF customers. You can't. So if you don't have that kind of money, either you pledge that much security to your broker, or you have that much cash in your brokerage account. Only then can you actually run a program without having this approve or disapprove button automatically in your exchange. Now, there is, of course, the larger question of, even with this 50 lakhs, can the provider of an algorithm be a person who is not recognized? Now, I'm assuming that I'm trying to solve for the problem of me running my own account. As a PMS manager, of course, it makes sense for me to say it. But I think also as a personal level, I wouldn't mind getting an approve yes or no button if I'm really small in comparison with a 50 lakh account. And above 50 lakhs, I want automatic approval. So therefore, I can go to my broker and say, listen, I want to run my algo. I have 50 lakhs in my account. Can you please allow me? The broker allows me. He says you can only do it if you have 50 lakhs in your account. And then it can go through with a special ID that says that Deepak Shenoy has run it on his own machine. If he is known to be manipulating shares, then I can tell you that this Deepak Shenoy was manipulating shares of his own accord. Now, I think this is a useful middle ground that solves the problem of small retailers getting gypped and the systemic issue. And I'll tell you, come to the systemic issue here. Every API is designed to be rate limited, in the sense, from one API key, I will not allow more than 10 requests per minute. That means 10 orders per minute. Many of them rate limit to that extent, which means that, I do want to automate, but I don't think I'll send more than 10 orders a minute. I'm fine. Or maybe 10 orders a second. I don't know. There must be some number that kind of. In an API, you could have 1,000 customers with 1,000 rupees each, all sending a buy order at exactly the same time for a small cap stock, which can make it rise high in price because there's impact cost, and this impact cost is severe. But this is not the intention of anybody around. Now, if it was human, they would have actually had some time differences in actually inputting the order. You versus me, I type faster, you type slower, so you might end up different time frames. Somebody might be typing faster than me, so they get in at a different time frame. So the typing speed effectively branches orders over time. Even a short period of time is enough. However, I think this is not useful. You can block this by saying, approve yes or no, because the time of response for a person to say yes or no will be different for different people by nature. And the latency of the network will help them that the orders don't go in exactly the same time. So you'll solve the integrity problem that any, rate limiting only solves it for one API. You have now multiple APIs, you can solve it for that. Even if you didn't go through, then you would have had to rate limit using a different concept, saying on a single IP address. So we may be a network, I may be sending it through same IP address. But the issue has been coming from API platforms who say, buy our API, give us your username and password, and we will automatically send orders. So they typically send that orders from one server or 2 or 3 servers. So from those servers, you could serve 1,000 customers, 5,000 customers, all of which will send orders at the same time. So since it's coming from one API address, more than 100 API keys within a period of 5 minutes, and you automatically hit a cool-off period. So you say, well, listen, it seems like you're running a platform that seems to be using multiple people to inside of it to use APIs to access us. So therefore, we want to bring in a cooling period now. So if you're doing this in 1 minute, the next 2 minutes, you don't get to send orders. your IP address. It gets flagged down. You could say, of course, there are technical ways of saying I use a proxy server and this and that, but eventually people will find out. This is a technology where eventually you can find out how this is being sorted. It requires some more work.
Also, it's a gray area right now because there's no regulation addressing this particular aspect, which is why the platforms can exist. But if they bring in a regulation, then it won't be a gray area anymore. So if you run a platform, then you run the risk of being the regulator coming after you and saying, how are you running this platform? That is one. But even if this is what the problem is, right? When people can become proxy fund managers with access to thousands of people's accounts and not yourself being a regulated entity. So a bad actor can, in theory, say, oh, this is a great strategy, generates 100% returns, and you subscribe to it. Or maybe they'll say only 20% profit share, no upfront fee. So people are saying, fine, if it's 100% returns, I'll subscribe to it. And what they can then do is go and find an illiquid option, buy it themselves, and then get other people to buy it, thousands of people, and then they make the profit, front run the whole thing. And you are not even regulated. So if somebody complains, then SEBI will be like, well, he was not regulated. Why did you even go and subscribe? So problem comes to you. But if you're regulated, then this becomes much more challenging to pull off.
This is actually one extra point to this is consider that a lot of fund managers who are regulated also get blamed for this. In the sense that if a fund manager, because they could say, oh, well, you know what? You guys have your own positions. And now you buy it in your customers' names and then you unload your positions onto the customer. This is specifically not allowed in a PMS or a mutual fund. A mutual fund can't, for instance, say, you know what, my promoter owns all these accounts, all these shares, I'll buy it from him. It has to be bought on the exchange. It's a related party. You have to report this. They could investigate and find you in violation of the rules. So because you're regulated, you get a lot of the regulatory influence that prevents you from doing it at the cost of something. At a algorithmic level, there is no end to how you can do this with other people's accounts. Now, if you're manipulating stocks out of your own account, you will be found out at some point. And the problem right now is the broker himself doesn't know you're coming through an algorithm. The broker thinks you're using an API key you generated with me, therefore you are the one who's generating these trades. And because nowadays IP addresses change every second or every few seconds, people cannot actually go and say, listen, I'll give you an access only through one IP address. Your home Wi-Fi will change IP addresses every day. Your office Wi-Fi will change. Your mobile phone IP address will change. So given that, they can't block it and say it's coming only from one API. I said your orders could come from anywhere. If a website decided to take your API keys and send orders by itself, the broker does not have a way to know unless the broker built some smart technology within themselves to say, listen, this particular website is sending me thousands and thousands of orders, each of which has different API keys. So this must be aggregator of some sort. And then you can go in and say, those such people, fine, do it, but regulate. If you're becoming a fund manager, then operate under the fund manager rules that currently exist, which means...
But there are no fund manager rules that allow you to do this because PMSs can't take leveraged strategies, net leverage. And AIFs also can only do max 2x leverage.
So they're taxed very badly, by the way.
Yeah. So if you are effectively a proxy fund manager, what are the regulations you are under?
So I just have 2 points I'd like to make here. The first is a completely different anecdote. So I hope it's relevant, but we have so many people using our products on small case. And they wake up on, Monday mornings or Friday mornings, and they go and they do their rebalances, as they're called. Wouldn't it be nice where they didn't have to do this and this sort of gets done automatically for them? That's one question. I think they would prefer that. But my second point is, look, is this really a problem? I mean, what we're talking about, this whole the scope of today's conversation. I mean, it's hard enough to get people to open Demat accounts and use them. Are we saying that there's really that many people out here who are just outsourcing their accounts to algorithms out there? And so can't we also take a call that, look, if you're the kind of person who's like, here, random algorithm, come and take over my trading account, then you deserve the consequences, good, bad, or ugly. I mean, so just 2 sort of related points, and wanted to get your thoughts on these.
I'll start with this one thing. I mean, I would equate it to, let us say there was a website that said, Shrey, give me your net banking usernames and passwords. I promise to make the right kind of payments for you so you don't have to ever pay late fees again. Uh, you will, whether this particular company had an ad featuring Rahul Dravid who's very angry, or it was even a website by a famous entity that you knew, the chances are you're going to be very skeptical because your question to me will be, Deepak, sab kuch theek hai, but if the other side is an algorithm, it's a program, it went rogue, it started paying people left, right, and center. What's to stop it? And I say there's nothing to stop it. If such things happen, well, you know what? You're on your own. So I think you would look at me and say, are you out of your mind? Because it's really an open-ended okay that you're giving without any control or any balance out. Instead, if I told you that, listen, this will automatically try to make payments, but you're going to get a little signal flag on your account whenever the amount is more than 5,000 rupees saying, do you approve or do you not approve? And then you'll be like, okay, now I'm okay because the max I lose is like 5,000 bucks and, in a day. So I'm okay with it. The minute you've introduced that little regulation, you've kind of made it easy for people to solve a problem, but also created a control level system. Right now, we don't have that control level system here. And although I would love to be able to say everybody can execute a small case or a portfolio bunch automatically, I recognize that there is potential of bad actors at every level. It could be us, it could be a small case, it could be somebody else. Anybody could be a bad actor in this whole place. The guy who suffers the consequences is the end investor. Therefore, I would prefer that they actually click OK on a transaction, every rebalance transaction on their own. I think small case also prefers that, in the sense that small case does not want people to, automatically say, okay, click one button, okay, and have that, because they actually show you the disaggregated set of transactions that happen. I think the system currently works in this thing that says, well, you know what, if something is coming through a small case, they're all okay.
And it's not even considered algo. For the most part. So I was just reading the consultation paper. It actually defines what they mean by algo trading. And they say an algo trading system automatically monitors the live stock prices, initiates an order when the given criteria are met. This frees the trader from having to monitor live stock prices, initiate manual order placement. None of this is true for small cases where there's no automatic monitoring of live stock prices. There are SEBI registered RARIS fund managers who actually publish the portfolios, and then it's a manual order placement, not even automated order placement. So I don't think there's an equivalence there where it even is on the same page, because very different things.
Small case, though to be fair, when they say API, they probably mean what small case uses also. Unfortunately, it gets clubbed in the same bandwagon.
Does it? I mean, it's the same thing. And how do we differentiate? That's the problem. Like, when I click a buy button on Zerodha Kite, it triggers an API. When you click a buy button on small case logged in through Zerodha, it also triggers a bunch of APIs, or maybe the similar set of APIs. And when you place an order through a program which uses Zerodha's API key and secret, that also triggers an API. How do we differentiate between these three different ways of executing the same outcome?
Which, I mean, I would say technologically, if it is such a big challenge we should allow it, because in the sense that APIs are actually good. I mean, APIs are 90% good, 10% bad.
It's not even a question of good or bad. I mean, they are real. I mean, you can't build apps without them.
Yes. I mean, of course, you could obfuscate at some level. You could say, I will call my buy sell and my sell buy. I mean, but it'll take a smart guy like 5 minutes to figure this out, right? So I'll click a buy, I'll see the API. Yeah, it doesn't. It's complete nonsense to try and do such. It at some level it is like the simplest of web programmers clicks F12 on a web page and gets to see all the traffic that's going through and can easily decode what you're doing on every buy and sell. What are the chances they won't figure it? They figured out binary transmission between a client and a server by doing this man in the middle attacks by a person sitting in Russia could do this between two people talking to each other in the US, what are the chances people won't figure something like this out easily? It's just unnecessary.
Okay. But maybe you could just opine on that second part I said, which is, look, how many people are doing this? I mean, are there people who are actually going around giving access to their accounts? And therefore, do we really care about protecting that very tiny subset of people?
According Nitin was on Twitter Spaces yesterday or day before, and he was saying 0.5% of Zerodha customers. But I'm sure, like Deepak said, 40 plus brokers are now offering execution APIs. So if you go to one of these platforms, you can integrate with any of those. So the easier it gets, more people who get attracted.
Let me also add one more thing here. It's not about where it is now. It could be where it is tomorrow.
Okay.
These people can do exactly what PMSs and fund managers can. So why should people register as a PMS at all? Why can't they just offer the algo and say, तू मेरे को account का number दे, मैं तेरा trade करता हूँ और तू मेरे को पैसे बाद में अलग से देना.
This is the kind of informal arrangements people have had for so long, which nobody looks at kindly, right? Ki this is very
Illegal,
grey, illegal, or in the grey area, and you better become a registered portfolio manager or an AIF to do this.
So
I think that is the problem. The problem and the whole motivation for this seems to be because these platforms have come up, which are now becoming like marketplaces for like algorithms, and anybody can publish. So on small case, you can argue they only accept SEBI regulated intermediaries to come and publish any small cases. But here, anyone can go. You can go. I can go. He can go. Anybody can go and publish an algorithm which can do whatever.
Yeah,
there's no regulation.
One of the more famous ones when I saw their website today is showing a list of marketplace of strategies. One of the strategies says, and this is a person, I don't know whether they're SEBI
Please don't
registered.
name them.
I won't name the pro, but 1,514% ROI. That's return on investment. There is no of course background to it, but it's just that's what he said. And the fees are X amount per month plus 30% of all profits generated. I look at this and say, listen, if it's not famous already, tomorrow hundreds of people are going to be running for this just by looking at these numbers, and there's no regulation. So at some level, you got to...
No, I agree.
There is current extent regulation that does not allow you to do this. You can't go around promising a return so... But I mean, having some layer of protection for smaller investors is not a problem. To me, I think saying ban is a bad idea, but say do it with one extra step that's going to make life difficult for some people, but it's going to eliminate the complete madness of the Wild West where people can freely trade anybody else's account. That may be a useful intermediate compromise with the overall factor of what Vashish said, saying, boss, if you're doing this as a platform and not for your own account, then you need to be registered in some way.
If you're trading other people's money, you have to be a fund manager or an AIF. You have to meet the same standard of requirements that other people are required. And if you're not doing that, if you're doing as a small person, doing it for yourself, I think you should be allowed to do it. For yourself. With some, I guess some limitation will be required where saying, if you don't have as much, I don't know, like Deepak said, 50 lakhs or 25 lakhs, something minimum, you don't get to do fully automated stuff. You have to click a button or something. But I think people will figure out ways to avoid that.
And this used to happen. The earlier technology, because it allowed, there was something called one touch and no touch. What they're trying to do is regulate no touch. No touch being there's no touch between the computer creating the order and the order being executed on the exchange. One touch is where the customer actually says okay to every order. This has been violated. We have known large funds in the US when there was only one touch allowed to have a person with his finger taped to the enter button, because the order, when it came up as an okay or cancel, the okay would be the highlighted button. So you would automatically just, if you're kept your button. It was okay because paying a person 10,000 rupees at that time, 2007, to be taped to the enter key for 5 hours a day was a perfectly good way to make money. And I still think it is. I mean, it may not be a bad way for a person to make money, maybe a multiple of that 10,000. But having said that, I would still be okay with that, because you know what? The fund is in question is a large fund. They're not going to go complaining to SEBI saying, my algorithm went rogue and therefore please protect me from myself. I think it's fair to assume that people will get around these regulations. Some people will. You just have to have enough regulation to say, just don't do this. I mean, we are doing these rules for a reason, and you have to have this 50 lakhs or some number of money before you can actually do algo level trading. This I know is an elitist argument because technically we're denying the small people their
Access to
ability
this,
to do this. But at some level, you're going to have to apply a broad brush. Otherwise, I don't know. In the US, you know what they do? They actually tell you that if you do more than 4 intraday trades a week, you fall into something called a pattern day trader. A pattern day trader cannot trade at all unless they have $25,000 in the account.
I didn't know. Okay.
So if you're a pattern day trader, you have to have $25,000 in the account. A US site that did this platform level investing, like we talked about here, called Covester, a good site.
They're still around. Yeah.
They've been sold now, and things like that. But they actually allowed a person to copy someone else's trade. So saying you automatically copy.
That's
whatever
huge in the currency CFD markets and currency markets.
And so on. This copy someone trades concept, while it has been a useful thing, they found that a lot of people suddenly started getting classified as pattern day traders because the guy they used to copy was a day trader. So now suddenly your account gets blocked and says, well, you can't proceed any further for the rest of this week unless you have $25,000 in the account. So, people got routed by saying, okay, I'll give you exactly 4 trades a week in my algorithm. So, that was, but what I'm trying to say here is there is a worldwide fight about how you need to regulate this. America has very difficult rules. When you cross a certain level, by the way, you can't sell options in the US unless you actually pass a test or go through a certain layer of experience, which your broker has to certify that you're good enough to be able to write options.
I should look at my Robinhood terms and conditions more closely,
yes,
I guess.
You actually have to, because you have to pass this, not everybody is allowed to write options. You can buy options because you can't lose more than the option premium. And when you write options, you can lose a substantially higher amount. So even forget a program. Any
naked short, I think you can do spreads though.
You can do spreads. You can't lose unlimited amount of money.
One question which comes to mind is, look, again, please, without naming anyone, who are the fear that both of you have had is that there's these rogues or these villains or these edge cases that will come in and destroy your account's value or cause you significant loss. So could you tell me, has this happened already? Is this happening, or is SEBI preemptively stepping in, or are regulators preemptively stepping in, or are there people who've had significant losses because of bad actors or unintended consequences?
Some people have. I think some people have complained as well, and that's why SEBI is taking these actions. But more than bad actors or large-scale market manipulation, I think there's a huge regulatory gap here, which they have to fulfill. And the way SEBI, it seems to me, going through the consultation paper, is that SEBI is passing on this responsibility to the brokers. Like Deepak said, in the US, brokers have to certify whether you have meet certain criteria or not. Like here, they say the brokers will determine some suitability for you. And the brokers might eventually become these platforms. Instead of these third parties setting up platforms and marketplaces for algorithms, brokers might become those platforms. I think Dhan's CEO, he wrote a note on his views on this whole thing. And there he was saying we should embrace APIs. Perfectly fine. And then you come to us. We will give you the platform. We will get your algorithms approved and we will introduce you to our clients, and then they can come and subscribe and get access to the algorithms, all regulated because SEBI is asking the brokers to do their due diligence. So that is one way it can possibly evolve.
When I talk about rogues and villains, I think the issue here is this: who falls outside the regulator's purview? One of the people who do is an unauthorized advisor, which SEBI always says is a problem, saying, how are you giving advice to someone else on their portfolio? Here, you're not only giving advice, you're actually executing that advice without the user's consent or express consent. So that would, according to SEBI, be a rogue or a villain in this piece, saying, listen, if you're not regulated, how do I even find out that you're doing the right thing or you're not doing the right thing, and give people a universal body to complain against you, saying this registration number, this person told me this at this time. So that is one. The second one are the platforms. So the platforms themselves enable such people. third-party people to say, I have 1,500% return. Please subscribe through this platform to my services, and I will charge you 30% or whatever that number is. The interesting thing about this is these platforms there is no extant regulation at all that applies to them. The brokers themselves do not know who these platforms are, because these platforms don't need to register with the brokers, with the exchange, with SEBI, with nobody. These platforms don't even have the algorithms. It's a third party that's registering the algorithms on them. So effectively, they become this loose entity that said, listen, I don't know if anything illegal is going on, but I'm just going to facilitate everything. They don't come under any extant regulation. So which means they can be their own fund managers. They have a view into what is happening with every single algorithm. And they could write a master algorithm that kind of does something more nasty to all of them as well. And
well, that a broker can also do. If
Yes.
they have prop desks, they can say,
desks.
oh, acha, these are the 100 algorithms running and these are all the loss-making ones. Let's do the opposite trade.
Which actually is true. And to be honest, to recognize this as a problem will take SEBI a lot more technology.
Or to
than
front run it.
Or to front run it, exactly. In fact, look at today.
I mean, if I know the rules of 100 algorithms and know ki, like all of these guys are going to buy it at this point, I can front run it easily.
Yeah, and I'll tell you something that's happening right now. And I know I hate to reveal this because this could have been a money-making strategy.
Yeah, go for it.
But if you look at some of the ETFs at 9:15 a.m., because many brokers allow after market orders. These are legal things that say after the market has ended, you can place an order. So people place an order for some of these ETFs. The ETFs don't have too much liquidity. Okay, so there's not many buyers and sellers right in the morning. So what happens is that because the exchange doesn't allow you to place orders in the night, at 9:15 a.m., the broker's algorithm places the order. In the order, maybe it is about 100 after market orders, it places them one by one into the exchange queue and the exchange takes them. A lot of these orders are market orders. Now, the market orders are simple. Whatever's in the market, take it. I can do 100 shares, I can do 200 shares, but I have 5,000 shares. And the people who are selling it have not yet even come to build their positions, right? They are not algorithmic. They've just put a little bit, there's 100 orders at 50 rupees, there's another 100 orders at 55 rupees. So by the time you execute 1,000, your price has gone from 50 to 75. And then it slowly comes back to 50 because of course the 75 price won't sustain. It's an ETF. There is an underlying NAV. It can't be more than that. If you looked at this, just this, you can see the impact of algorithms as they currently stand. And by the way, there is no regulation that prevents this. These are licensed algorithms from the exchange. They're doing what they're supposed to do, and yet they're causing price spikes in the market. So are they rogue? Of course they are, according to me, because they're not offering, I mean, you can't have a price spike from 50 to 75 rupees without, I'm not saying that it always happens, but I'm just saying that this kind of a thing has a potential to be really disruptive. And people aren't complaining today because largely they don't know. So at 9:15 a.m., if my order got executed at 75, I would think the price of that underlying thing is 75. Then I look at it 2 days later and I say, the market is flat. I've lost 30%. How? And then they come back, and after a while, this is like, you churn and churn and churn. One day, suddenly somebody comes back with this, oh my God, we've all been gypped by this, whatever this algo is. They'll go to SEBI. SEBI will find out what happened. They will say, ban after market algorithms. This is how, unfortunately, regulation works. But I think we could see this right now and say, don't tell these players not to send all their orders at 9:15 a.m. In some way. You don't have to send it at exactly 9:15 a.m. You can spread it around because you're affecting prices.
That's the core of the problem. Individuals doing it on their own, it's fine.
Yes.
The moment there is pulling together of intent, that's where the problem lies.
I think that's the right key phrase, pulling together of intent.
Pooling of intent. Yeah, I mean, I think, and I hate to say that in general, we already have too much regulation. And I think regulation of the sort that requires an MBA to do anything is a very bad form of regulation.
You'll have an MBA soon.
I know, but and really, we are a PMS also, so we shouldn't say that regulation is good or bad because technically we come under the regulated as a regulatory frameworks. So, but I think people should address intent. there is a problem. This is not like there is no problem at all. It's like the crypto world. Everything is good because it's the new web. Even if there are scams, outright scams, people selling air as NFTs, people say it's okay because,
It's new.
It's new. Yeah.
Future.
At some level, it's not, because it's somebody's money that's going down the drain, and there has to be, if there isn't a regulator to regulate you, at least the players together can come together and regulate, at least from on their own.
That's new. This is well established.
Yes, true.
I think we need another podcast for that one.
For a crypto NFT and
So, if you don't mind, I'll end with maybe just your thoughts. Do you think we started the thing with SEBI doesn't want your next fund manager to be an algorithm, but do you think, say, 3 or 5 years from now, algorithms will play a bigger role in managing your money or a smaller role than they do today?
I can tell you one thing about us, and this is not a secret. We run portfolios where sometimes we have to buy a large quantity of shares at any given point in time. Now, we run the risk of opening our hand if we were to put these orders manually on the exchange, because sometimes we have to buy, say, 5 lakh shares or something. There is not enough liquidity. If we were to put 5 lakh shares ka order at any given point in time, we will not get it. Now, there are algorithms worldwide that allow you to do this. They are called VWAP algorithms, saying, every 5 minutes, place a little bet. If the price is above the VWAP, don't buy. If the price is below the VWAP, buy. VWAP is a volume weighted average price. We would like to use such an algorithm in the capital mind frame of mind, in the sense that it will give better execution to our customers. It will not reveal our hand. And maybe we could buy these stocks over a period of 2 or 3 days instead of all at once, without us having to have 5 traders enter something in 5 minutes, because that's a cost that we have to bear. And then if a trader quits, then because of too much work of this sort.
And you taped his fingers to the keyboard or whatever.
The keyboard. Yeah. So you actually use the technology element for its best, which is to actually do something that is not disruptive to the market rather than try to disrupt it. So I think the future of all fund management will be some level of automation. But the other thing that we want to run, for instance, is index funds, let us say. I don't think any index fund in this country can run efficiently if it was only to be manually traded. Every day you get new funds. That new fund has to be deployed according to the way the index is on that particular date. What are you going to do between 3 and 3:30 just getting your funds? I mean, think of a mutual fund manager who gets funds by 3 o'clock. At 3 o'clock, but 3 to 3:30 he has to deploy those funds. Is he going to bring all those funds, put Excel sheet, put this, acha, itna iska khareed, itna uska khareed, send it to all the brokers, call them up and they'll say, हाँ sir, itne mein fill hua, हाँ ठीक है. This is not how it should run. It should be like a program that says 3 o'clock, so many funds, please deploy across multiple brokers if you may, use the APIs and get the best price possible. This is how a system should run. It is more efficient, it is less costly, it is also more precise than anything a human can do. And this is the future. Whether we like it or not, we are going more passive. If passive is the future.
What this consultation paper has confuses people with is they use automation and algorithms interchangeably. But that's not true. Like, if you ask the future, algorithms play a huge role. As you are seeing already, there's so many more rules-based funds and ETFs getting created. Nifty indices has a ton of them. Momentum, low vol, alpha, mid-cap quality, and so on. And there are more and more ETFs and index funds coming up. So clearly, algorithm going to play a huge role. Automation is necessary at institutional scale. There's no way to get efficient execution without automation. Individuals, I think, should be allowed to do whatever the hell they want in their accounts. The problem is this pooling of intent because you create proxy fund managers which need regulation.
So with that, let's end today's episode. Thanks so much for listening, everyone. If you've made it this far, please take note of the discount code CM Podcast for a 10% discount on a Capital Mind Premium membership. You can see more of our episodes at capitalmind.in/podcast. And while you're on our site, you can learn more about our do-it-yourself and fully managed portfolio management service at capitalmind.in. Deepak has a book out called Moneywise. It's available on Amazon, Flipkart, or shop at .capitalmind.in if you want a personalized copy. And if you have any feedback, suggestions, or topics for our next episode, please send over an email to podcast@capitalmind.in. So thanks, everyone. See you next time.